So one of the things we would expect if there was going to be a recession is that people become more worried in the stock market. So earnings don't do very well, corporate earnings don't do very well in the middle of a recession. So if you really thought a recession was imminent, you'd be worried about the stock prices, and you'd start seeing stock prices decline. Stock prices are within 2 to 3% of their peaks, so we haven't seen that yet. Now, some people would argue that the people that invest in the stock market are very different than the people that invest in the bond market. And when they're listening to the stock market or the bond market, they rely on the bond market. Even if you believe that, one of the things you would expect if there was a recession is that you'd see credit spreads widen. So if you think about a corporate bond versus a US government bond, there's a lot less risk for the US government bond. If you're worried about a recession, you're going to need a higher return in order to buy that corporate bond. So you'd expect yield spreads to widen. That's what we're not seeing. We're not seeing that widening occur. So the financial markets are showing kind of a mixed message, and I don't take nearly as much information from the fact that we have an inverted yield curve as some of my colleagues. So when we think about what the policy ought to be in this kind of context, what are we weighing? Well, right now the US economy and most forecasts of the US economy by people that are taking into account both the trade concerns and what's happening with business fixed investment come up with a growth rate around 2%, which is to say they're not seeing a recession, they're seeing growth pretty much like what we were seeing in the second quarter. If you look at some of the financial market data, particularly looking at the inverted yield curve, you may be much more concerned. So we have to decide which of these signals we ought to be paying more attention to. And I would argue that this is a time where we really, in the opening comments, we talked about data dependent. I actually think this is a time we really have to be data dependent. There are two aspects that are really important. One is, does the consumer continue to spend? So that is a critically important issue. And do we continue to see strong growth in employment? As long as we're seeing consumption and employment being relatively healthy, I'm not nearly as worried. But there certainly are some pronounced risks, and they do threaten the US economy. Tariffs are certainly one of them. The global slowdown is another. Those kind of headwinds could become more appreciable. If they do and they start slowing down the economy, I think we should react once we see it in the data. But I don't think we should anticipate necessarily that that's going to happen. So as long as we're growing around 2%, I don't see nearly as much of a need for taking immediate policy action.